Welcome to the deep dive. We got a source in from you, our listener, that just landed today, June 11th, 2025.
That's right, and it tackles something pretty critical.
Yeah, a new twist in U.S.-China trade, and specifically how it's hitting, well, small businesses.
The article we're digging into is how the China trade deal announced today will impact small businesses. It's by Chris Lehnes, who's a factoring specialist.
Okay, and our goal here really is to cut through the noise. Let's unpack this tentative agreement. What is it really?
What does it mean on the ground for small businesses? They're already under so much pressure.
Exactly. What relief does it offer, if any? And maybe, most importantly, what are the strategies experts like Lehnes suggest for navigating this, well, incredibly messy landscape?
Well, the first thing Lehnes points out, and it's striking, is that this isn't being sold as some grand fix. It's framed more like a temporary stabilization.
Okay, temporary stabilization. Let's break that down. So it's tentative, but what's the actual structure it seems to be formalizing?
According to the analysis, it's basically locking in the status quo. You know, what we've seen for the past year or so.
Which means?
Which means the U.S. keeps its, roughly 55% tariffs on a whole lot of Chinese imports?
Right.
And China hangs on to its 10% tariffs on American goods. So the big tariff picture. Essentially, no change with this deal.
Wow. Okay, so there's an announcement, a deal, but the main tariff structure just stays locked in place. That feels like the first major takeaway.
Definitely.
So if the big tariffs aren't changing, what are the concessions? The article mentions limited ones. What did China actually agree to here?
Chris Lehnes flags a few pretty narrow things. China agreed to issue export licenses, but only for 6 months, specifically for rare earth materials.
6 months, okay. Anything else?
There's also mention of a modest sort of loosening of export controls and easing restrictions on student visas for Chinese nationals.
6 months for rare earths, a little easing on controls and visas. Yeah, that does sound very narrow, just like the analysis suggests.
It is.
So the key point here, no matter how it's spun, is that any relief for American small businesses is, well, conditional and pretty thin, right?
Exactly. It really doesn't touch that fundamental tariff burden that's been weighing them down.
And to really get the impact of this specific limited deal, we need to remember the backdrop. What pressures were small businesses already facing before this announcement?
Oh, immense pressure. The article details quite a few significant challenges they were already juggling.
Right. They weren't exactly starting from a comfortable spot. What were the big pain points Lehnes highlights?
Well, first off, increased supply costs. Huge issue. The analysis really focuses on this for retailers, manufacturers, e-commerce sellers, basically anyone importing goods.
And a big part of that was the change to the de minimis exemption, wasn't it?
Yes, exactly. The removal of that $800 de minimis threshold hit hard.
Could you just remind us quickly what that was and why losing it was such a blow?
Sure. So that rule basically allowed shipments under $800 to come into the U.S., often without tariffs, or at least with much less customs hassle. When that went away, a lot of smaller businesses that relied on importing components or maybe finished goods in smaller batches suddenly saw their costs jump, sometimes overnight.
Okay, that definitely explains a lot of the cost pressure. What else were they dealing with?
Just sheer planning uncertainty. It was rampant.
How so?
Well, if you don't know if or when tariffs might change, how can you confidently decide on inventory levels or pricing?
Yeah.
Or making investments to grow.
Yeah, that kind of unpredictability makes running a business incredibly difficult.
It really does. And that uncertainty feeds right into cash flow problems, which, as you know, is absolutely critical for small businesses.
The lifeblood, right.
Totally. So you had shipment delays, sudden price hikes. It led to situations where businesses got stuck with too much inventory that was now too expensive for their customers.
A nightmare scenario.
It really messes up that vital flow of money. Plus, these higher input costs just hammered their competitiveness. Larger companies often have, deeper pockets. They can absorb costs, or they have big teams figuring out complex supply chain shifts. Smaller players, they just don't have those resources.
Makes sense.
Yeah.
And you mentioned customers reacting earlier.
Yeah.
How did that play out?
Chris Lehnes writes that many small businesses had no choice but to pass those costs on.
Which led to?
Customer backlash, unfortunately. Prices go up, some customers start looking elsewhere. It erodes that brand loyalty small businesses work so hard to build.
Okay, so that's the tough backdrop. Uncertainty, rising costs, cash flow issues. Now, let's bring it back to this new limited deal. How does it specifically impact different small business sectors, according to the article?
Right, let's go sector by sector based on the analysis. First up, manufacturing. Here, the article suggests maybe moderate relief.
Moderate relief. Okay, given everything we just said, that sounds like, well, at least something. Why for manufacturers specifically?
It really comes down to those 6-month export licenses for rare earths we mentioned earlier. Businesses using those materials, think electronics, defense subcontractors, advanced manufacturing, they might get a temporary breather, a bit more consistency in their supply chain. That helps with production planning.
But the big flashing warning sign there is the temporary part, isn't it? 6 months?
Exactly. It's right there in the description. 6 months is hardly enough time for real long-term strategic planning. It makes it incredibly tough.
And the risk is that the chaos just snaps back once those licenses expire.
Precisely. It looms large.
Okay, what about e-commerce? We know they were hit hard by losing that de minimis exemption.
Yeah, for them, the analysis paints a picture that's minimal to negative, unfortunately.
Still feeling the squeeze then?
Very much so. Online sellers were already struggling with that de minimis change, the higher costs. This new deal doesn't roll back tariffs, so they're still caught. Costs are up, but customers expect low prices online.
That sounds like a really tough position.
Yeah.
What's the risk land sees for them?
It's significant. The article suggests many sellers might just find it unsustainable. They could leave the market entirely, or maybe even look at moving operations overseas to try and escape these costs.
Wow, okay. And traditional brick-and-mortar retail, your average local shop relying on imports.
Largely negative for them, too, according to this analysis.
Why is that?
Well, think about stores importing housewares, maybe specialty ethnic foods, certain clothing lines. This deal offers them no cost reduction on those goods.
And they don't have the scale of the big chains.
Exactly. They lack that buying power, so
Yeah.
they face really hard choices. Hike prices significantly and risk alienating customers, or cut back on the products they offer to manage costs.
Neither sounds good. The article mentions risks like lower foot traffic, shrinking margins.
Yeah, and potentially even closures in some cases. It's tough out there for them.
How about agriculture and food processing? Any impact there?
The analysis sees it as pretty negligible.
Negligible. Wow.
Because most U.S. food exports are still facing those 10% Chinese tariffs. This deal didn't change that. So small farms, specialty food producers, they're still at a pricing disadvantage.
Compared to bigger players who can maybe absorb costs or find other markets?
Right. Larger competitors might have more flexibility. The risk for the smaller guys is losing export competitiveness, maybe ending up with too much product domestically if they can't sell it abroad.
Okay, and lastly, professional services like consulting, legal, education.
Here, the analysis suggests it's potentially positive.
An upside.
A potential one. That easing of visa and academic restrictions we talked about, over time, that could stimulate demand for services that operate across borders, maybe foster some new partnerships.
So a possibility, but maybe slow burning and dependent on other factors.
Exactly. Lehnes notes any benefits here would likely take time to show up, and they really depend on broader geopolitical stability holding up, which, is still a question mark, even with this deal.
That's a good point. And it brings us to what this agreement doesn't fix. What are the big underlying issues for small businesses that this deal just doesn't touch?
Yeah, that's a critical piece. Chris Lehnes is very clear. There's no roadmap here. No clear timeline for actually de-escalating tariffs or bringing back broader exemptions like de minimis.
So no light at the end of the tunnel on that front.
Not provided by this deal, no. And the relief that is offered, like those 6-month rare earth licenses, it's just too short for meaningful strategic planning. Businesses need more predictability than that.
And is there any mention of, say, government support programs to help businesses navigate this?
The article doesn't highlight any new corresponding federal domestic support tied to this deal. Nothing specific mentioned to help affected firms directly.
Or things like infrastructure programs to help them, say, shift supply chains or upgrade digitally?
No, none of that discussed in relation to this specific agreement either. And those nagging differences in regulations and standards between the U.S. and China.
Still there.
Still there. The analysis points out there's no progress here on harmonizing things, which continues to be a barrier for small businesses trying to export efficiently.
Okay, so given all this, the ongoing volatility, the very limited nature of this deal, what does the analysis actually recommend? What strategy should small businesses be focusing on right now?
The core message from Lehnes is about being proactive and building resilience. Number one strategy, supply chain diversification.
Makes sense. Don't put all your eggs in one basket.
Exactly. Look beyond China. Find suppliers in countries with lower tariffs. Consider nearshoring, Mexico, Canada, or even explore domestic production if it's viable for your business.
Okay, diversify the supply base. What else?
Product portfolio optimization. Take a hard look at your products. Which ones are most exposed to tariff impacts because of where they come from?
And then,
The advice is to maybe shift your focus. Lean into products that are less affected or those that have higher profit margins, giving you a bit more cushion to absorb potential cost bumps.
smart. Focus on what's working or less exposed. What about the money side? Financials.
Absolutely crucial. Financial planning and resilience. Businesses need to do some serious scenario planning. What happens if tariffs go up? What if they stay the same? How does it hit the bottom line?
And exploring tools to help with cash flow.
Yes. The analysis specifically mentions things like factoring, that's selling your invoices for immediate cash, or looking into SBA loans, trade finance options, anything to keep that cash flow stable when things are unpredictable.
Right. Get creative with financing to ride out the bumps. Can businesses do anything to influence the situation itself?
Lehnes suggests advocacy and alliances. Join your trade association, your local chamber of commerce, industry groups.
Strengthen numbers.
Basically, these groups can pool resources, offer a stronger collective voice when talking to policymakers, and advocate for small business needs in future trade talks.
And talking to their own customers.
Super important. Customer communication. If you do have to raise prices or change products because of these trade issues, be transparent. Explain why. It helps maintain trust.
Be upfront about the challenges. Good advice. And finally,
Digital adaptation. Lean into technology. Invest in better e-commerce platforms if you sell online. Use CRM tools, customer relationship management, to manage interactions better. Improve your logistics software.
efficiency gains to maybe offset other costs.
Exactly. These tools can boost efficiency, maybe cut costs in other areas, and improve the overall customer experience, which is always vital.
Okay, so that's a pretty solid playbook from the article. Diversify supplies, optimize products, manage finances tightly, advocate collectively, communicate clearly, and leverage tech. What about the bigger picture? Does this deal do anything for the broader economy, according to the analysis?
Lehnes suggests the impact there is, well, conditional. And probably uneven. There could be a slight improvement in investor confidence just from having some temporary stability, even if limited. That might make borrowing conditions a little easier for businesses. Potentially.
Okay, a potential easing of credit. What about inflation?
Yeah.
The Fed's watching that closely.
Right. The analysis notes this temporary stability could help the Federal Reserve in its ongoing efforts to keep inflation under control. It's currently stated at 2.4%, so maybe it helps keep things steady-ish.
And jobs. Any impact on hiring?
The limited clarity might encourage some cautious hiring, maybe in specific sectors like logistics, warehousing, perhaps some small-scale manufacturing that sees a minor benefit. But the key word is cautious.
So it sounds like these potential wider benefits are framed as possibilities, not guarantees, dependent on other things.
Very much so. The article concludes that these broader economic boosts really hinge on deeper structural reforms, the kind this deal didn't deliver. Without those bigger changes, this deal alone is unlikely to spark a major recovery, especially for the small business sector.
Right. So wrapping up our deep dive today on this June 11th U.S.-China trade deal, using the analysis from Chris Lehnes. It seems the picture is less about a breakthrough and more about, well, a temporary pause, maybe.
Yeah, a temporary truce seems like a good way to put it. It doesn't really knock out the underlying trade tensions. And crucially, it offers pretty minimal overall relief for most small businesses already struggling.
And the big takeaway from Lehnes seems to be that survival and success now really depend on strategic adaptation, getting involved politically through advocacy, and just building operational resilience.
Absolutely. The message isn't relax, it's fixed. It's more like, okay, the landscape is still volatile, double down on your strategies, manage the instability, and grab any small advantage you can.
Which leaves us, and you listening, with a pretty important thought to chew on. If these kinds of temporary truces and ongoing uncertainty are basically the new normal in global trade, how does that fundamentally change the kind of long-term planning any business needs to do, big or small?
Right. And what lessons can we all draw from these adaptation strategies, diversification, resilience, communication, not just for trade, but for navigating pretty much any kind of constant change in the world today?